Is 2025's volatility over? BlackRock says not even close. In their 2025 outlook, they make it clear that the data shows this wave of volatility is far from over globally, and their analysts overwhelmingly agree. The next decade will belong to active portfolio management. Just look at this chart of the VIX performance over the last 12 years. Volatility like this demands a sharper strategy. If you're a swing trader exhausted by unpredictable markets, it may be time to go market neutral with a tested strategy that's outperformed 2025's early volatility by 30%. And no need to be an expert to make it work. By the end of this video, you'll know exactly how to trade volatility and win. But who am I to tell you this? I'm Brian Tancock, a Wall Street veteran with 20 years of portfolio and risk management experience at Citi, BlackRock, and for clients around the world. Now at Visual Sectors, I work with our data scientists to validate strategies that simplify complex trading signals. After testing hundreds of ideas, we found the edge traders like you need, blending option source data with traditional methods. Here's how you can do it with a winning market-neutral strategy. Imagine you love flying kites, but you're terrible at predicting the wind. You could complicate your kite flying with a bunch of fancy weather monitoring tools. Or you could fly two kites, one for each wind direction, and increase your odds of catching that sweet updraft. This strategy was popularized by Jim Simons for his famous medallion fund at Renaissance Technology Capital. The idea is simple. You go long on some assets and short on others at the same time. If the market drops, you win your shorts. If the market soars, you bag profits on your longs. But how do you know which kites, that is, assets, to buy? With factors. Essentially, pick a market or stock factor with solid predictive power. Then go long stocks that perform well in that factor and short stocks that underperform at a certain value of that factor. For example, say you build a long-short dividend portfolio using dividend yield and safety. In your market-neutral approach, you buy the top 10% of stocks with the highest yield and safety, and then short the bottom 10% with the lowest yield and safety. So when the market corrects, the safer ones hold steady and your long positions don't decline too much compared to how far the short stocks have fallen. But what about the risk that the market could take off on a bull run? Or the cost of borrowing to short stocks? That's where we come in handy. To start, our market-neutral strategy focuses on a weekly time frame. We also pair two factors, support and resistance levels, and options-derived indicators, namely sentiment and accumulation change. We'll come back to the specifics of that in a second. First, a word about options. Since the dawn of options, traders and researchers have looked for ways to predict how the underlying assets will move. After studying over 50 research papers exploring option-stock relations, we've confirmed one crucial fact. Options traders thrive on information asymmetry. Basically, these traders know a bit more than the average market participant. To the point, options flows can react to news that hasn't hit the airwaves yet. And we've tapped this asymmetry to sharpen our stock support and resistance framework and our stock gains. Our market-neutral strategy suggests going long stocks sitting at support levels with positive sentiment while shorting stocks at their resistance level with negative sentiment. Of course, you can use traditional indicators to draw lines on the chart to identify key levels, use a Fibonacci extension, or etc. My problem with these indicators is that they only have meaning when other people use them at the same time. But true support levels are supported by fundamental buying power. We believe market makers' hedging activity can be that power. Imagine, options traders buy 10,000 call contracts. Market makers are then forced to take the other side of these contracts by writing or shorting the calls. That exposes them to massive directional risk. So they go to the stock market and buy just enough stocks to cover that risk at 10,000 contracts times 100 shares per contract times the delta of the contract. For calls with strikes close to the current price, that can translate to as many as 500,000 stocks. But they can't sit still. They have to reposition when the stock price moves. Fun fact, this mechanism is exactly how retail traders moved GameStop more than 2,000% during GameStonk. Watching those accumulations gives you real insight into where true support and resistance levels are. And that's why we created our sentiment chart and accumulation change indicator. Now we're back to our market-neutral strategy. We make it easy to use this information to identify which stocks to go long and short with our screener tool. Simply go to Screener and choose Accumulation Change Strategy and Close to Support. Then, sort results by direction moving upwards. Make sure that resistance is not too close. The accumulation changes support the bullish case across change periods and expirations. And there's enough liquidity that looks like many bars with thousands of open interest. Now pick the 7 names you'd like to go long for the week. Just be aware that the accumulation change indicator updates weekly on Tuesdays before the markets open, and that indicator is valid until next Monday till after the market closes. Then, reverse all metrics to identify 7 short opportunities. Close to resistance, down accumulation change indicator, with support not too close and a bearish case consistent across change periods and expirations. Pretty simple, right? There's still one massive risk we haven't addressed yet. That's idiosyncratic risk. When a shorted stock swings so far, it wipes out all your long profits. But we have a solution for that too: position sizing. You can opt for the traditional 1% of your account per position, but that won't really help your profits. It just minimizes the impact on your assets. That's why we prefer volatility sizing. Basically, you look at how volatile each stock is compared to the S&P 500. We've got you covered there too with our Knowledge Hub. Just divide your preferred position size by relative volatility to calculate your ideal investment amounts. Pretty cool, right? And it's totally free to use. So how does this strategy perform? To be honest, I didn't expect it to be this impressive. Over the initial 10 weeks of live testing, our strategy was profitable 7 of those weeks, despite wild market swings. While the S&P dropped 6.3%, our test sample posted a hypothetical profits of 18%. In other words, this strategy has a lot of potential. It's clear, easy to use, and it simplifies active strategies in the face of enormous market uncertainty. And we'll help you make it work. Want the full strategy, guides, and tools? Just join our Knowledge Hub. The link is in the description and it includes the volatility calculator too.